Hi friends, welcome back to FinveStocks. Today we are going to cover the 10th session on technical analysis. Here we will see multiple candlestick pattern. Last week we covered bullish engulfing pattern as well as bearish engulfing pattern. On this video we are going to cover Harami pattern, that is bullish Harami as well as bearish Harami pattern. First let's understand what is a multiple candlestick pattern. Any pattern wherein the involvement of candlestick is more than one is called multiple candlestick pattern. In a single candlestick pattern, we need just one candlestick to identify a trading opportunity. However, when analyzing multiple candlestick patterns, we need two or more candlesticks to identify a trading opportunity. That is the definition of multiple candlestick pattern. So last week we had seen engulfing pattern, that is also one of the multiple candlestick pattern. In this video, we will cover Harami pattern. So let's see what is a Harami pattern. Harami pattern is a two candlestick pattern. The first candle is usually long and the second candle is very small. The second candle generally opposite in color to the first candle. So once you spot the Harami pattern, a trend reversal is possible. There are two types of Harami patterns. One is bullish Harami and the other one is bearish Harami. So let's see in detail what is bullish Harami and what is bearish Harami. The word Harami came from Japanese word, means pregnant. The candle pattern resembles a pregnant woman. That's why the name came Harami. The bullish Harami pattern is bullish in nature and this pattern normally appears at the bottom of downtrend. As discussed earlier, the Harami pattern is a trend reversal. The bullish Harami pattern evolves over a 2-day period, similar to engulfing pattern. This is a typical representation of bullish Harami pattern, wherein the downtrend continues and at the end of downtrend, a green candle emerges. That candle will be inside the bearish candle. So now let's discuss how to identify Harami pattern. When the market is in downtrend, pushing the prices lower, giving bears absolute control over the market. So on a downtrend, we are identifying where the trend reversal is happening. On day 1, the pattern P1, a red candle with a new low is formed, reinforcing the bear position in the market. So on the next day, that is day 2, we will call as P2. The market opens at a price higher than the previous day's close. On seeing a higher price, the bears got panic as they were expecting a lower opening price. The market gained strength on P2 and managed to close on a positive note. So thus forming a blue candle, that is bullish candle. However, this P2's closing price is just below the previous day of P1's open price. So that makes the candle inside P1. So the price action of P2 creates a small blue candle or a bullish candle which appears inside the long P1 red candle. The small candle, that is the small bullish candle, blue candle, on a standalone basis shows harmless. But what really causes the panic is the bullish candle appears suddenly when it is least expected. The blue candle not only encourages the bulls to build long position but also shake the bears. The expectation is that panic amongst the bears will spread faster, giving a greater push to the bulls. This tends to push the price higher. Hence, one should look at going long on this stock. So here in this chart, it shows a typical bullish Harami pattern, wherein there is a downtrend and at the bottom of downtrend, a long red candle is being formed. So the next expected candle is red as this is a downtrend, but suddenly it forms a blue candle or a bullish candle that is just inside the red candle. So that forms a Harami pattern, that is bullish Harami pattern. One can expect a upward momentum or trend reversal from this pattern. So as you can see in the chart, the momentum continues, the positive momentum continues and it went to an uptrend. So now let's see the trade setup for bullish Harami pattern. So here the idea is to go long on a bullish Harami formation. So the risk takers can initiate a long trade around the close of P2 candle, that is the second candle. Risk takers can validate and confirm whether this P1 and P2 together form a bullish Harami pattern or not. So how to check whether it's a bullish Harami pattern or not? So the opening of P2 should be higher than the close of P1, or the market price at 320 on P2 should be less than P1's opening price. If both these conditions are satisfied, one can conclude that both P1 and P2 forms a bullish Harami pattern and one can go long on that. And for the risk averse, can initiate a long trade at the close of a day after P2. That is, once the pattern is being formed, and he can wait for the next day. On next day, if it is confirming the bullish pattern, one can go long. And the stop loss for the overall trade will be lowest point of P1 or P2, or you can say the lowest point of the formation. This is another typical example of bullish Harami pattern. Here in this chart, the below encircled candle deposit a bullish Harami pattern, but actually it is not. The prior trend should be bearish, but in this case the prior trend is almost flat, which prevents us from classifying this candle pattern as bullish Harami pattern. So one should carefully analyze and see whether the pattern formed is bullish Harami pattern or not. This is another typical example wherein bullish Harami occurred, but the stop loss has been hit and the trade didn't went as expected. So always all the trade what we expect will not happen. If the conversion ratio is more than 50 to 70%, still you can be profitable in a trade. The upward momentum or the reversal didn't happen, and finally it had hit the stop loss. Now let's try to identify some of the Harami pattern in the live chart. Now let's see some of the banking stocks, say ICICI Bank. So here you can see a perfect Harami pattern wherein downtrend continues, and on the last candle, that is P1, it is a bearish candle, and the next candle forms a bullish candle and it is inside the bearish candle. So it forms a Harami pattern. So the next candle will be green and then it will continue the upward momentum. So here for both risk takers as well as risk covers will be profitable in this trade. Similarly, this pattern shows Harami pattern on bearish side. This is bearish Harami pattern. So once the uptrend continues and after the final bullish candle, the next candle form will be bearish and that will be inside the bullish candle. So forms a Harami pattern. And once this pattern is formed, it will give a trend reversal and the stock price will come down. So the bearish Harami pattern appears at the top of end of uptrend, allowing the trader to initiate a short trade. So here in this chart, typically you can see on the uptrend, after the bullish candle, that is P1, P2 candle is bearish in nature and the trend continues. The trend reversal continues and it will give a momentum opportunity or trading opportunity to short. So in the top of the uptrend, after the bullish candle, a bearish candle forms inside the bullish candle and it forms a bearish Harami pattern. So for risk takers can go short at the closing of P2 and they will get a profitable trade. In case of risk covers, they will wait for next day to form a bearish candle. But here unfortunately the candle formed is green or blue and that is bullish in nature. So here risk covers will not go forward with the trade and they will miss the golden opportunity of having a good trade. If you are new to this channel, please do consider subscribing this channel. And don't forget to like, comment and share if you like the video. As a summary, the Harami pattern evolves over 2-day trading session, that is P1 and P2. So on day 1, that is P1 candle, the pattern forms a long candle and day 2, P2 candle forms a small candle which appears inside the long candle. So a bullish Harami candle pattern is formed at the lower end of downtrend. P1 is a long red candle and P2 is a small blue candle or a bullish candle. The idea is to initiate long trade near the close of P2 for risk takers. A risk averse trader will initiate the long trade near the close of day after P2, that is the next day after P2, after ensuring the candle formation is blue or green or bullish. The stop loss for the bullish Harami pattern is the lowest price of P1 or P2. The bearish Harami pattern is formed at the top end of uptrend. P1 is a long blue candle or a bullish candle and P2 is a small red candle. The idea is to initiate a short trade near the close of P2, that is for risk takers. And the risk averse will initiate the short trade the day next to P2 after confirming that the candle is red. And in upcoming videos, we will go more into detail of different type of multiple candlestick pattern. Morning star, evening star, white soldiers, all these patterns with examples we will see.
Please do like if you like the video and don't forget to subscribe to get the notifications of upcoming videos on personal finance and stock market. Please post your valuable comments. Do follow the Friday Basics to make your stock market journey easy. Thanks for watching and have a good day.